Good afternoon. My name is Gia Lane, and I'm Customer Account Manager with RKL eSolutions. I'd like to welcome you to our Beginner's Guide to Everything Sales and Use Tax. I'd also like to introduce Andrew Quirk. Andrew is our Regional Sales Manager for Avalara. I'm the Customer Account Manager for the East Coast, and Rachel Roselli is our Customer Account Manager for the West Coast. So after this webinar concludes, if you do have any questions, you can either reach out to myself, Rachel, or Andrew. Andrew is going to be presenting today, so I'll turn it over to him. Thank you.
Thanks, Gia. Appreciate it. As Gia mentioned, I'm Andrew with Avalara, and happy to speak to everyone today. Glad you could join. And at Avalara, we make a commitment to our customers that we want to make sure we get good feedback from everybody. So myself, Gia, or Rachel will follow up with everyone on the call today in the next 24, 48 hours just to get general feedback, on a scale of 1 to 5, how helpful it was to you, what resonated, what do you think was important to your business, and just basically get general feedback so we make sure that we're servicing our customers, and also going forward we improve our processes as well. So thanks again, Gia, for kicking it off, and I'll just start the presentation. Specific to today's conversation, here's what we'll be covering. Talk about why sales tax matters, different topics around sales tax such as Nexus and products taxability. Talk about the forgotten tax, use tax. We'll get into exempt certificates and exempt sales, and we'll also talk about audit planning, the problem with services, sourcing such as bill to and ship to, and then what it looks like to automate all of this for your business. So before I get started, if anyone has any questions, please feel free to raise your hand in the WebEx window or type a question in there. And if I don't see it, Gia will point it out. I'd be happy to answer any questions as they come up. So what we'll be covering specifically with why sales tax matters, we'll discuss how sales tax helps state deficits, what are some compliance challenges, and ultimately, how do companies try to address these sales tax compliance issues. A study was done a few years ago, and the outcome was that 31 states had budget deficits, and the total projected shortfall was $55 billion. This is obviously why sales tax has become such an important topic. When you add up the general sales tax and tax on gross receipts, that's about 47% of a state's total revenue. When you look at a state like Washington, per se, that has no income tax, sales tax becomes even more relevant. It's a key way for states to raise money and bring in revenue when they have no other streams to do that. So what it means to you is that sales tax is not a choice. Unfortunately, it's a statutory requirement. If it was optional, I'm sure nobody on the call would do it. Since we have to collect, states expect us to do it and do it correctly. If not, it can result in back taxes, penalties. For companies to comply, companies find it to be pretty labor-intensive. Trying to comply in a new state in which they're required to collect can be overwhelming. With all this, there's still some human error that can cause mistakes. And with the rules always changing, how can a company keep up? Last year alone, there were close to 14,000 rule changes in the U.S. If a company is managing sales tax, close is really not good enough anymore. There's no reward for doing it correctly. It's expected and required of you, but it's not reflecting your bottom line, and it's non-revenue generating activity. It's something you don't want to do, you just have to do because unfortunately the government makes you do it. So why is sales tax so complicated? There's a vast number of criteria to manage sales tax correctly across the U.S. As you can see, there are over 150 million mailing addresses, over 12,000 jurisdictional rates, 35,000 sales use and rental tax rates. There are over 30 million product service exemptions and over 750,000 buyer-seller exemptions, all of which generally requires a ton of research to manage. Just to give you an idea on how this impacts businesses and what this can mean to you, There were a few surveys a few years ago. One of the questions was, because these changes happen so frequently, how often were people updating their sales tax processes? And the result, believe it or not, was only that 44% could remember the last time they updated the process. Factor in on top of that, if you ask how confident they were in doing it correctly, nearly 48% said an auditor probably would find a mistake if we were to get audited. And lastly, on average, an audit could cost nearly $115,000. I don't know about your business, but most businesses would be greatly affected by this unplanned business expense. Again, it's something where you're mandated to do this. It doesn't generate any revenue for your business to work on these processes, but if you do it incorrectly, you could have to, pay the costly cost of fines and penalties. Also included in the survey was how much time was spent on sales tax compliance. There are plenty of discrete activities. For example, researching the rates on the state's websites, building tax tables into accounting systems or e-com systems, et cetera, et cetera. You have to research what the implications of the items that you're selling. You have to collect and manage exempt certificates. You then have to prepare and file sales tax returns and cut checks. And when you add up all those activities, the time involved for a small to medium business equates to almost 2 full months of work just to be compliant. That's right around 302 hours annually that companies lose to manually managing their sales tax compliance. This activity creates a certain amount of risk and effort to be compliant, obviously. Another snapshot of an activity, if we go back for a second to filing it in the remitting process, on average, companies can spend upwards of 11 hours a week just managing their filing and the returns. So again, it's time-consuming activities that aren't making the business profitable. Let's transition for a second to a few things that you need to know about being tax compliant. Avalara provides technology to help companies automate their sales tax compliance processes. Inevitably, what we find is that when we're talking to companies that are thinking about outsourcing, they ask questions about tax policy and other parts of compliance, such as, what is Nexus and why do I care? Or in other words, where should I be collecting? What do I do when I collect? And, it's pretty challenging for companies to get their arms around it. We'll talk about what it is, what are the right questions to ask, and a little bit about Nexus rules and how they're changing around e-commerce. Just a little background, the concept of Nexus was upheld during a court hearing in 1992, and ultimately the Supreme Court said unless the company has created Nexus, which then they defined as a substantial physical presence, the company cannot be required to collect sales tax. There was something in the law that was left out, however, and that was what exactly is a substantial physical presence. And the definition is actually left to state statutes. So states have been changing and augmenting laws to require, more states to collect. Understanding Nexus, so knowing where you are required to collect. As I said, Nexus describes the connection between a state and a business. Having Nexus allows a state to compel an out-of-state company to register and then obviously collect sales or use tax. The out-of-state company must have physical presence, but again, as I mentioned, that definition is changing all the time. Most companies know when they start the business where they need to collect based on where they have a physical office or building. Here's just a list of some activities that are a lot less subtle than having that physical presence. For example, going into a state to provide services such as maintenance or repair. Amazon fulfillment is another way to conduct business, but can trigger Nexus when you have tangible property in one of their warehouses. Doing things to grow your business by going to a trade show, even as an attendee. This doesn't encompass everything, but it should certainly get you thinking and give you reason to research states in which you might be conducting business in some manner. So obviously the definitions of Nexus are growing because the states are trying to recoup more money. These definitions are broadening as we speak. Again, let's keep in mind billions of dollars that are being projected as shortfalls by the states. There was a study done by the National Retail Federation, and they found that the amount of uncollected sales tax due to remote selling online where our company has a web store and is selling into a state where they don't have Nexus, is upward of $24 billion. So obviously this is a lucrative area for states to try and tap into where tax hasn't been previously collected. One interesting thing to note is what we saw a few years ago with the state of New York as they passed what we'll call, I guess, an affiliate nexus law or a click-through nexus law. And unfortunately what that law said was that regardless of your company having Nexus, if you're selling through affiliates, even something as an affiliate posting a banner ad on a website that directs traffic to yours and you pay commission to them, it could create Nexus based on the business. Once New York did this, you can imagine other states followed suit, such as California and Illinois, with their own version of the law. This isn't the only thing to keep your eye on, though. You've also seen recently at the federal level that the Senate has passed the Marketplace Fairness Act, and although it hasn't been ratified in the House, there are competing bills as well. You see the federal government isn't trying to close loopholes as well. You have to keep in mind that when the initial laws were passed, the Internet was still in its infancy stages, so we live in a different time now. So again, the biggest takeaway for you should be that more companies are going to be required to collect just by the nature of how our economy is changing. One thing we did when putting this presentation together was some research around companies that conduct online sales, and we found that about 70% of companies that conduct sales online, of those, only 47% collect in a single state, which means that they're not collecting in states that passed Amazon laws and may not be aware of legislation and how it could affect their business. So it's just an ever-changing environment that, it's imperative that businesses stay aware of it. So if you understand Nexus and have it applied to your business, then you understand where you need to collect. The one thing that's sometimes hard to determine is jurisdictional assignments, and the issue that companies have used zip code methods historically, and that challenge simply is this: zip codes don't line up with taxing jurisdictions. Probably in my time, just being here with Avalara, that's probably the number one thing I come across when talking to businesses is that they just rely on a zip code, and quite frankly, you just can't do that anymore. We've seen areas across the country where within a zip code there are multiple taxing jurisdictions. These are state, county, city, and special taxes, which can be confusing about how lines are drawn. Zip codes are a step in the right direction, but can lead to incorrect calculation and give companies a false security. If you're overcharging the wrong rate, it can be a customer service issue. And with all the business being done online, it becomes part of pricing and competition for folks that can find it cheaper somewhere else. So zip codes just are unreliable at this point. And just to give you a taste of that, what you're looking at right here is Greenwood, Colorado. This whole area is one zip code, but it is actually made up of 4 different sales tax rates. So literally businesses that are next door or across the street from one another actually fall within different taxing jurisdictions. And as you can see, it obviously becomes problematic for a business when you just assume too much in terms of aligning zip codes on where your transactional information goes. Another thing you want to be aware of is product taxability. Just talk about why it's confusing, and then give some examples and taxability issues and what industries are affected by it. Product taxability basically is simply that. It's the assumption that most every state, if you sell something that is tangible personal property, the item is taxable unless there's a statute that specifically says that it's non-taxable. The opposite is true for services. Most services are assumed to be non-taxable unless enumerated by the Department of Revenue in terms of being a taxable event. These rules vary state to state, as does other rules that we've discussed. And here are some industries that have varying taxability rules. For example, software companies have to deal with whether or not the software is canned or off the shelf, who the end user is, whether it's downloaded off the internet or shipped on a disk, all of which can play into how the software is taxed. We're seeing the same thing with digital goods. If you walked into a bookstore 20 years ago and bought a book, unless the book was a Bible or a religious book or a textbook, they were treated as a tangible good and were taxable. But we live in a different world today, and we buy stuff online, so when we download a book to a tablet or download a PDF from a website, states are making changes accordingly. Just to point out one, Washington State, with Amazon being there, has already made the change to tax digital goods. But if you download a song on iTunes in California, it's still treated as non-taxable. You also see a variance in these other industries. You also see sales tax holidays where things that are generally taxable are not, such as back to school, tax holidays, and the list keeps growing and growing, state by state. And the rules are evolving. Let's take a look at another example. This is a candy bar, and with or without flour can actually determine its taxability. If it has flour, it's considered a food, and if it's not, it's considered a candy. 24 states have different rules regarding this as well. Another thing is for beverages and energy drinks. One thing to keep in mind is whether or not it's carbonated with a supplemental label ultimately determines whether or not it's taxable or exempt. It's important to understand which of your products are taxable and why. And these are just two examples that we pulled out. But again, how can you keep up with the challenging landscape? So I'll take a minute to discuss the forgotten tax, use tax. I'll note some differences between sales and use tax, but we also want you to understand that use tax is not just the consumer's problem. It affects businesses as well. Sales tax by definition is based on an intrastate transaction. So if you bought a bicycle from a store, you would pay sales tax. Or if you ordered it from Amazon in the state of Washington and it's shipped from Seattle to Bainbridge Island, which is where Avalara is headquartered outside of Seattle, that too would be taxable. There's a different type of tax when buying and selling across state lines, and that's seller's use tax, which is an interstate transaction where the seller is compelled to collect because they have Nexus. Going back to the bike shop example, I own a bike store in Washington, and somebody buys from me in Colorado. Because I attended a trade show there, I was required to register there. I would be required to collect the use tax on behalf of the customer because I was the seller. The difference and what customers are most confused on is consumer's use tax. What we typically see is when I, as a business, buy something from an out-of-state vendor and they're not required to collect tax because they don't have Nexus and therefore are charging zero tax, I, as a business, need to self-assess and pay the use tax directly to the government. It's therefore incumbent on me to realize what products and services are taxable, but then also realize that if I haven't been charged, then I need to self-assess and pay. There are certainly challenges here because you might buy things in bulk, store them in the warehouse before selling them to other customers, but in certain cases you may pull those out of inventory for use within the business and therefore create a use tax. Providing promotional materials, both of which could require you to self-assess and pay use tax. When you look at consumers in the marketplace and they buy things online, very few, if any, know about use tax, and those that simply don't comply. But it's very important from a business perspective because this is where companies unfortunately get audited. Another tenet of doing sales tax compliance within your business is around exemption certificate management. So I'll spend a minute or two here about why auditors are very serious about these exemptions and where the burden of proof lies. Generally speaking, collecting exemption certificates is a source of risk for every business. When audits happen, auditors are looking for $0 transactions, and when they are, they want to see the appropriate certificate to back that up. Here are a few reasons why a company could be exempt. It could be the type of business that the company is. This could be government, religious organizations, nonprofits, but the company must obtain the proof from these organizations as to why they're exempt. Another type is a use-based exemption in which a company buys something that is typically taxable by nature, but the way the company uses it is the sales exempt. For example, if I'm a distributor that is looking to buy something to resell, I would have to provide an exemption certificate. There are quite a bit of challenges around certificate management because there are multiple things you must do. First, you must collect the certificate, obviously. You must ensure it's on the right form. You need to make sure it's completely filled out. Different states have different forms, and sometimes company can miss certain aspects of it when filling it out. And you must also make sure it's valid. For example, in the state of Florida, certificates expire annually, so if you haven't done business with a customer in a year, it's important you go out and collect a new certificate. And, talking about that, let me give you something to think about. When customers start collecting certificates, they're building a process around paper management. But let me give you an example of an Avalara customer, Northern Tool, that prior to using Avalara, they were missing one certificate and it ended up costing them $20,000. They did everything they could to get that customer to provide the certificate, but they realized that certificate management was actually currency management. And what I mean by that is, if that one document that they didn't have represented 20 grand in terms of a fine, they now feel like they're managing money, not managing paper, which in the end made them question the process they had in place and whether or not it was a good fit for their business. I'll take a little minute here and talk about audit planning. Preparation and avoidance is your job and our job as well. We would love to keep an auditor's pocket empty from businesses out there and customers of ours as well. And we'll provide you now with a checklist of items of things that you may be doing or not doing that can create or minimize risk. We've talked a few times about the shortfalls in the states, so it's important to point out the increase in audits and the states hiring auditors, as we've seen several announcements about this. For example, California and Idaho hired or are hiring a great deal of auditors. It's kind of scary to point out that Idaho hired them as temps to see if they could move the needle on revenue. But since it was so successful, they actually brought them on all full time. With this increase, it's important you keep in mind when you think about sales tax and how you're managing it today. Some common mistakes you can avoid are failing to file a return, as it can put you on the state's radar. Other things are failing to report sales accurately. Filing returns with errors is never a good thing. Returns information that doesn't match other records. And not using the same numbers across the business on other forms. Mistakes found in a previous audit. For example, California has a 3-year look-back period, and if you're audited, it's likely they'll be back every 3 years to review the prior findings until you show an improvement. So a poor past audit could mean future audits. Obviously, inappropriately using certificates to buy goods, and also not reporting on use tax. So if you're a company and trying to ensure your books are in order, here's some ideas on how to reduce audit risk. Here's what we typically recommend to folks, is that if you have not done a Nexus study analysis, whether internally or hired someone, that's probably in order. You want to review your business activities and make sure you capture your exposure that's been created based on the states you made connections with. You certainly want to stay up to date on rates and boundary changes. Sometimes states send out notices of changes, but you may not always receive them. Make sure you report your consumer use tax. This one sounds like a no-brainer, but we work with a lot of companies that have been non-compliant in the past, and while there are ways to address this through voluntary disclosure agreements, they're never fun to go through. So if there are any new businesses on the phone, do the research from day one so you don't have to worry about the auditor come knocking on the door. And ultimately, just automating sales tax compliance with technology is always a good answer. Also, make sure you have an understanding of your filing requirements. So make sure somebody at the company builds a filing calendar of when returns are due and which forms are required. Make sure you don't rely on zip codes. Do more due diligence. It will keep the government off your back, and your customers will certainly appreciate it. Do research in new states about how your products and services are taxed, And this is surprising, but companies fail audits because they can't provide accurate sales records to auditors. Again, you would think it's a no-brainer. Keep sales-exempt documents, and the best method of managing and storing exempt certificates is, again, foolproof for passing an audit. Moving on, there's a lot going on with services. The economy has shifted away from selling stuff, if you will, to a service-based economy where things we used to buy are being delivered in a different way. It's important to understand what's taxable from a service perspective, but also what's changed and what is likely to change, and to ultimately, what that means for your business. The general assumption that services are non-taxable is a fallacy. Services can be taxable, but certainly are not always taxable. In order to understand how to tax these services, you must understand the difference between how states look at tangible personal property, services that surround this, how they look at real property services, professional services, and unfortunately, services is a very broad term, and just as we saw that taxability around goods varies, the same applies to services as well on a state-by-state and jurisdiction level. Here's an idea of some services that are commonly taxed. Amusement park tickets are largely taxed, cable TV is taxed, telecom is taxed, data processing, remodeling, et cetera, and the list goes on and on. So again, it's independent to each business. If you're charging for services, you want to make sure you're charging the right taxability. Many states tax these, and by evidence on this slide, you can see that if something is TPP, tangible personal property, and not a special good, it's easier than services. But services certainly create a challenge when digging into the details. Many states tax these services. Let's point out some states, and what the trend is that all states that impose a sales and use tax impose its tax on some services. States that tax many services are Connecticut, Hawaii, New Mexico, South Dakota, and West Virginia. But there are states that don't tax many services like Alabama, Florida, North Carolina, Oklahoma, and Utah. These trends are likely to change. A few years ago, the state of Minnesota passed a law on taxing services, and when this conversation comes up around the budget shortfall, this is the way to shore up that gap. We'll continue to see this more around cloud services and other technology services. A further nuance to taxing sales appropriately is a bundled transaction where a sale of multiple sales tax objects are bundled into a single sales price. There could be huge sales tax implications for your business, and it can be challenging when you charge a customer one sales price for all objects instead of separating them out. States take a dim view of bundling as services take a larger role in commerce. More transactions include a service. Standalone services, when separately stated, present a challenge in itself in determining taxability by themselves, especially because states take on different views of this. They just want to understand what you're selling so they can collect every penny owed to them. A final piece here is around sourcing tax. Are you sourcing the correct tax? Meaning, is it destination-based? Was the rule around sourcing, et cetera, et cetera? There's destination-based and origin sourcing. What we mean about origin is a ship-from address or a warehouse location where the goods are being shipped from and shipped to is the destination of the goods. Or if it's services on site, it would be the address where the services are performed. The good thing over the years, states have moved to a more uniform process around this. Most every state has a destination-based model, but there are some outliers such as Illinois where it's still origin-based. I want to spend a minute or two here on how your company could benefit from sales tax automation. It's no secret that because Avalara is putting on this webinar with RKL that, we're a sales tax technology company, and there's a trend in the marketplace that companies are using Avalara to automate these processes. There are some steps to look at before you automate, but it's all about offloading those manual steps to experts, and we can spend time talking about how that automation works. So again, the time you're spending on doing it manually now, you can outsource it to a company like Avalara, and that time that you are freed up now you can spend on, making the business more profitable. I'm going to keep it pretty short here, but obviously the value proposition of outsourcing and sales tax are listed here, and it lines up very well with payroll outsourcing. Payroll outsourcing became very popular in the 80s, where companies recognize it not as a competitive advantage for me to manage it in-house. In fact, it's a bit more of a risk if you do it wrong, because you'll have the government coming down and you'll have employees coming down on you. Ultimately, the trend is that companies are using technology to save time and money while increasing accuracy, which leads to reduced exposure, improved efficiency, and a realignment of internal resources that were tied up in manual sales tax compliance. So automating the process, these are some ways to quickly figure out if automating makes sense for your business. It's hard to determine how much money is spent on manual sales tax compliance, so we tend to rely on Aberdeen studies and other studies on the market to show what the average company does. There's generally always a cost of doing it yourselves, regardless of how many states you're in, the products you sell, the current processes in place, etc., etc. There's usually a lower cost when outsourced using technology. Once the process gets automated, companies eliminate researching rates, building tax tables, collecting and managing states, filing tax returns, cutting checks. This becomes an end-to-end compliance model and allows businesses to focus on the things that make them better, such as growth and providing value to their customers. I hope that this information has been helpful today. We know there were a lot of concepts that I went over. That probably raised a lot of questions. And we've been keeping track of those over the month I've been doing this. So I wanted to go over the basic sales and use tax, overriding issues and whatnot. And here's some common questions that pop up. And Gia, do you see any questions?
No, we don't have any questions at this time.
Okay. I'll just go over some ones that have popped up over the months I've been presenting this. Which Sage ERP systems do you work with? Obviously, we've been an OEM vendor with Sage since 2007, Sage 50 through Sage X3. In addition to that, if you have, an accounting custom system outside of Sage, we also have an API that works as well. We work with, obviously, Website Pipeline, which is an e-commerce site. We have over 400 pre-built integrations into shopping carts, POS systems. Obviously, our exemption certificate integrates regardless of the source. And, how long does it get to take up and running? With pre-built connectors specifically into Sage, most people are up and running in a few days, so it's pretty seamless. On average, myself, I add about 3 to 5 customers a month. I know with RKL we've added several this year with Gia and Rachel, so it's definitely a product that customers find value in, and not only they find value in, it works, and it eliminates a lot of manual processes. So if no questions pop up, my name's Andrew again. There's your reps at RKL's information. Feel free to reach out to them, and as we promised earlier on the call, we'll be following up with everyone that took the time out today to join in the next 24 to 40 hours and just try to get some general feedback from everyone. Thanks again, and if we don't have any questions, I think we completed the webinar.
Thank you for your time today, Andrew. I appreciate it.